am very, very happy that you are continuing in the class. As you can tell from the first two chapters, we jumped right into the deep end when it comes to financial accounting. And it was done for a purpose. We wanted to get you immersed in accounting with the terminology, with the background from the beginning, just giving you the reason why we're here, preparing statements that people use to make decisions. So jumping right into the structure, the format of a financial statement, including balance sheet, income statement, statement of cash flows, and the statement of retained earnings was a very important shift, I think, in how this course is being presented. But I'm hoping in the end you'll see that if you just keep focused on why we're here and what we're doing, the end product is the financial statements. Obviously, we're not talking about auditing, or we're not talking about managerial accounting, which is very, very much a very specific part of accounting. We're talking about financial accounting using corporations across the country, and in some ways it applies internationally. So I'm hoping that didn't discourage you at all, but you were able to glean some good information and it be helpful to you as we proceed through. We're going to talk about the fundamentals of why transactions are recorded the way they are, and also why they're presented the way they're presented on the financial statements, and also how information is narrated in the terms of notes on the financial statements. So I'm hoping that this chapter gives you a lot of background information. I don't think it's a lot of computations that will kind of trip you up. It's more theory and concepts that I think is essential, because you need to know why you're doing what you're doing. Not just the what of it. So getting started, we're going to do as always. When you're looking at your chapters, it's kind of important that you understand exactly what you need to get from the chapter. Don't waste your reading on just reading for reading's sake, but reading with a purpose. And the learning objectives is that purpose. Why are we reading this chapter? Because we want to know how what accrual accounting is, really, and then how does it differ from cash-based accounting. We're going to talk about the revenue and expense recognition principles, which guides almost every transaction that you're going to create ever. Also, it's going to talk about how to adjust the accounts. And again, adjustments, meaning why will we adjust? We're going to talk about why we adjust. And then we're going to talk about how to adjust. And then we're going to go through the really the fundamentals of constructing financial statements. And again, it's not real hard, but there are some rules I think are important that you need to understand, because you see a set of financial statements and they look a certain way, and they look a certain way for almost every company that you've ever looked at. Why? And the construct of it is going to really help you with that. Closing the books. Once we've created our financial statements, again, we're talking about a organization that is a corporation for the most part, and what we're trying to do is figure out how can we get these financial statements in a format that's correct, is accurate, that presents fairly all the information or financial transactions for that period of time, a year, 6 months, 3 months. And then once we're done, we really are done with that period. Remember, 12 consecutive months is an accounting cycle, generally a fiscal period or accounting period or a calendar year, but it's 12 consecutive periods. Sometimes we do 3 months, 6 months, but for our purpose, and particularly in this chapter, I'm talking about 12 consecutive months or comprising a year. We're going to talk about how to close the books, how to start fresh in a new fiscal period, and we're going to talk about ratios. Every chapter, I believe, will have a ratio or two that you'll need to review. And I would suggest you review them, because at the end of the course, we're going to go take all those ratios that we've seen in each one of our chapters, and we're going to compile them into one big chapter called Financial Analysis, which we'll talk about later. But for the most part, I would most certainly take a look at those ratios that we're using in this chapter and see how they correspond to the different areas of the balance sheet and the income statement, so that you can better make decisions, or at least understand the decisions that need to be made based on these ratios. So how are they different? First of all, accrual accounting is going to be the recognition of transactions when they occur. Okay, and then how do we record those transactions when they occur? How do we what are the fundamental principles that guide how those transactions are recorded, and the why of it? We are going to be talking about everything in light of GAAP, which is a generally accepted accounting principles. And so GAAP is going to be fundamentally telling you just is how we decide based on rules and based on presentation and all of these different concepts, how these transactions are going to be recorded, how they're presented, why they're presented, what we disclose, what we don't disclose, how do we create estimates, how do we create allowances, etc. That's GAAP. for the most part. Then we're going to talk about revenue when earned and then expenses when incurred. Now, on a cash basis, a lot of companies internally would use cash basis because they really want to be able to understand their transactions in a sense of how monies come in and how monies go out. So we're not going to record transactions when we earn it. We're going to record it when we actually get money from our customer or when we pay a bill. So cash in, cash out, ignoring important information. Again, cash basis has its place, but when you're talking about a full set of financial information, it ignores a lot, and which is why it is not acceptable for external reporting purposes. And obviously it's incomplete because there's a lot of transactions that are not shown if you're just going to record a transaction when cash is involved. And it's only used by small companies. Again, many companies do use cash basis, but it's for internal purposes. When we talk about financial statements in this context, in this classroom, we're talking about external financial reporting for corporations. Very, very specific. So that's very clear. Accrual accounting. It records transactions like collecting from customers. It records cash when paid or earned, when paying salaries and other expenses, when borrowing money, when paying off debt, when issuing stock. We want to record transactions, and we record them when they have been incurred. That's really what's the most important things. We want to deal with not only the cash side of things, but we want to deal with the non-cash side of things. Sales on account, that means a receivable. You're going to expect something from your customer. You did the work for them, but then they're going to have 25 to 30 days to pay you back. That is on account. You buy a purchase of inventory, and your vendor says, well, you know what? I'm going to do you a favor. I'm going to extend you 30 days to pay it back. That's an accounts payable. Expenses that you have incurred or made use of, but you haven't paid, nor have you recorded them. Depreciation, again, that expense has to do with assets that you've recorded, but you want to allocate the cost or allocate the use of that asset over its use, over its lifetime, which could very much be many years, 3-5 years, longer than an accounting period, which is 1 year. When you pay for something in advance, for example, you pay for your insurance 12 months in advance. Well, accrual accounting says we need to match that insurance when we use it, not when we pay it, because you're paying for 12 months. So we want to allocate that money that we've used, or that insurance expense that we use every single month. So we have to record the usage of rent or prepaid rent, insurance rates, or supplies. If you buy supplies, it's not an expense to you until you actually use it up. So accrual basis really does give you an item of comfort that you have completely recorded transactions for your organization. It's a much more complete, accurate picture of what your organization is doing. So time period concept, again, it's all about within the period of time. We want to talk about accounting period. Accounting period is a year, 12 consecutive months, 3 consecutive months. Companies do present financial information in interim periods, 3 months, 6 months, 9 months. But for the most part, in general, we're going to be talking about an accounting period as 12 consecutive months. It could be considered a fiscal year, which is noted here. It could be a calendar year, which is noted here. Either way, it's 12 consecutive months. And we report accounting information at regular intervals. And most organizations, particularly ones that are public, are going to report information annually. So, revenue and expense recognition rule. The revenue recognition rule, it deals with the recognition or the recording of revenue and what amount do you record. When to record it is when it is earned. It's earned when the business transfers the goods or services to a customer and an amount that reflects the fair market value or other consideration. Period. You did the work. You transfer the information over or transfer the date or whatever it is over to them in a sense of a service that you provided or a product that you've given them. That transaction has happened. We got to record that transaction and a value of that transaction. Now, generally speaking, it's not a big deal because when you're doing business with a client, you are already going to spell out exactly what you're going to do, when you're going to do it, how you're going to do it, and how much it's going to cost them. So this entry here is really just no nonsense. You know what you're going to do for your client. You know when they're expecting the work to be done, and you know exactly how much they're willing to pay for it. You have it exhibited in a contract, and that's all it's saying. We're dealing with when we record it. That means when the services is done, when the product is delivered, and we know how much. We need to have both bits of information. And when we don't have both, guess what? We'll talk about that later. The revenue recognition rule is okay. Now let's deal with the other side of the coin, is the expense recognition rule. And it's generally called the matching principle, but nevertheless, it records expenses in their appropriate period. When the word incurred is used, the question then becomes, what does incurred mean? To me, incurred means, did you use it? Did you have use of something? Do you have use of your supplies? That's an expense. Do you have use of your insurance? That's an expense. Do you have use of the asset? In this case, your building. It's an expense. Now, that expense could vary. It could be a depreciation expense. It could be a supplies expense. It could be other kinds of expenses. But did you have use? Was something used in that period of time? And we want to match it in the same period that we generate revenue. And that's why it's the matching principle, because we're matching the use of something or the expense that we've incurred in the appropriate period of time, so we can recognize it in the same period that the related revenues are earned. So we're matching it. That's why the expense recognition rule is commonly referred to as the matching principle. So we want to recognize expenses as incurred. Incurred in your context was most likely say, did I use it? Did I make use of it? Did I have the ability to use this service, this product? The thing is, if it's being used, it has to be incurred. If it's incurred, we have to record. Boom. If we can learn it like that, I think it might be a little bit easier to grasp. So we want to match it. We want to make certain that we match those expenses when they have generated the associated revenue in that period. So matching it in the appropriate period so the two can go together. Adjusting the accounts, we are, again, when we record all our transactions for the period, every single one of our transactions, we are able to generate a trial balance. A trial balance is a listing of accounts and their ending balances in debit credit format. Now, this is an unadjusted. That means that all these accounts are not adjusted for any type of accruals or any type of adjustment that's necessary for the use of assets like a depreciation or accruing of expenditures that we have yet to record. So we want to show this is going to be your first step in creating your financial statements. You're going to use the trial balance, but you may need to make some adjustments. And we're going to talk about the circumstances by which certain accounts have to be adjusted in order to be accurate for purposes of the financial statements. So let's take a look at these accounts. Remember, noticing that cash or assets are noted first in order of liquidity, and equity, and then liabilities are noted in order of maturity. And then you have your equity, and then you have your revenues and expenses. And it's important to do that because it most certainly makes it so easy for you to prepare financial statements when you can see the accounts in the order, in their proper order, in the correct presentation. And again, this is all about good form and why we do what we do as accountants, and why things are systematic and very, very easy to follow when you're looking at one statement from one company to another. Okay, I'm going to be done with this trial balance. Now, there are times when there are certain circumstances within our transactions where we have to record an adjustment, meaning the unadjusted amount is not complete. That's all it's saying. So there are three categories of adjusting entries in general, and the ones that we're going to talk about and the ones that you need to know are deferrals, depreciation, and accruals. Now, deferrals are going to be, I would say, an example would be a prepaid. If you purchase your insurance for 12 months in advance on January the 1st of 2018, and you're ready to close the books at December 31st, 2018, you have to record 12 months worth of expenses. We are deferring the recording of the expense until the time that they have been incurred. That's basically what it is. So prepaids would be part of that. Another deferral would be if you did services, or no, actually you received cash from your client. If you received $10,000 from your client on January the 1st, and the work is yet to be started, and you're already getting ready to prepare the financial statements for December, you have to defer recording the revenue for that transaction until the earnings process is complete. That's another example of a deferral. We do not want to record it now. We have to defer or push it forward until the timing recognition has been satisfied. Depreciation is the allocation of cost of an asset. They say planned asset, but I'm going to say a long-lived asset because I think that's far more accurate than a planned asset. And we want to take that long-lived asset and we want to spread the use of that incurring of expense over its lifetime. That means that a long-lived asset is going to have a lifespan longer than a year, and we're going to allocate that proportion of that use of that asset each and every month until that asset is being used up. Then we have also the accruals, and these are going to be the opposites, and what it means you have received benefits of someone's service. That could be salaries and wages that your employees have completed the work. That could be taxes or any other type of expense that you've incurred, but you have yet to pay that. So let's take a look at how to record them. Now, this is going to be something that you have to deal with your project, so it's going to be important that you really pay attention here. When we have transactions that we paid in advance, we have to make certain that it is clear it is an asset to us. We have a future benefit, and the technical definition of an asset is a future benefit. You have a future benefit, it's an asset to you. However, the type of asset it is, depends on the circumstance, but in the end, it is an asset to you. So if we have prepaid rent, we paid our rent in advance. When we record the transaction, we can't record a rent expense because we have not used that rent yet. We're going to defer using that rent to the future. We have to say, in the future, I have a benefit of 3 months worth of rent expense. That's a benefit to me. So now I know I have a prepaid rent, and a prepaid rent is going to be an asset to us. So it's going to be on the balance sheet. And here's an entry to give you an example of how that's recorded. And each and every month, or however the organization decides to record the transaction, generally should be once a month, we're going to record 1/3 of that rent that we paid in advance. So we're going to remove the part of the benefit and show how much we've incurred or used. And in this case, $1,000. That $1,000 entry is called an adjusting entry. So when we prepare our financial statements, we need to show that we have used 1 month of the 3 of the prepaid. And it gives you 2 presentations on how to use it, how to look at it from a T account perspective and also from a journal entry perspective. The same is true. So for example, if you have assets and you purchase them for $700, the moment you purchase it does not make an expense. You have to use that asset before it is actually an expense. So in this entry, we're recording the asset of $700 called supplies, and we're going to reduce our cash because we paid with it. We paid cash for it. But when we count how much we've used so far, if we have $400 of supplies remain on hand and we purchased $700, the difference is what we've actually used. And our adjusting entry is going to be an expense, and we're going to reduce the asset called supplies. Now, again, long-lived assets like land and furniture and building, we want to make certain that these assets and the use of these assets are matched in the appropriate period, which is why we use depreciation, and depreciation allows us to do that. Other than land, all other assets have a finite life. It has a lifespan. Land generally does not. It generally sits on your balance sheet until something happens to either you sold the asset or the asset is somehow impaired. Otherwise, land remains on the books at the price that is purchased. Historical cost, basically. So if I'm going to be buying some equipment for $24,000 on credit, here we have the entry. We increase our asset called equipment, and we increase our liability called accounts payable. So if we're going to, now the amount of the depreciation expense really varies based on the depreciation method that you use. We have a number of those, and we'll talk about that later on. So don't get into the details of how to calculate depreciation at this point. I think it's a little bit premature. The most important thing that you need to learn in this chapter is how do we record the use of a long-lived asset in the adjustment process. That's all you really need to know. Using straight line, using double declining, using sum of years, all of that will be discussed in a previous chapter. For now, I just want you to focus on the entry itself, and that is the depreciation expense and accumulated depreciation. And it's also important to note that accumulated depreciation, which is the credit in this case, is not an asset or a liability. Accumulated depreciation is called a contra account because it is there specifically to offset an account. In this case, it's going to be a contra asset. It's going to be offsetting an asset. In this case, it's going to be offsetting the equipment asset. And we'll show you how it looks on the financial statements in just a bit. So accumulated depreciation shows the sum of all the depreciation over the asset's life. It is a contra account, and it has a normal credit balance. Because it's a contra asset account, it's going to always have a credit balance. If it were a contra equity account, it would have a normal debit balance. And again, contra means offset. And here it looks like on the balance sheet. Again, it is a contra account, and it's going to have a credit balance, and is intended to offset the equipment account, which this $23,600 shows the book value of that asset. And again, we're going to go through a lot of terms, so don't lose heart. These terms are going to be familiar to you over time because we're going to use them over and over and over again. So I'm introducing a new term, book value, and it's going to be the cost of that asset minus the accumulated depreciation. And that number is going to be quite important when we talk about depreciation in future chapters. Now, next, we're going to talk about accrued expenses. Again, it's going to be a liability that has already arisen, and it has not been paid nor recorded. It has to meet both criteria. It is a liability that has been arisen from an expense, and it has not been paid, and it has not been recorded. That's most important. And this giving you an example of typical accruals. Salary accruals is one of them. And here's the entry. Again, I want you to focus on the entry and not necessarily on the calculation at this point, just to get you familiar with the type of entry, the debit and the credit. The dollar amounts obviously it's going to vary, and that's not the most important. The most important is what do you debit, what do you credit, and why. Now, when you have to accrue, however, you have to say, I have received benefit from my employees, but I owe them money. I haven't paid them back yet. So instead of it being a credit to my cash because I haven't paid them yet, actually payroll doesn't even begin until the next week, so I don't have to pay them until next week. But for the purposes of my financial statements, I have to show everybody who reads it that I have some obligation, in this case, to my employees. So I'm going to debit my expense. I made use of what their services were, but now I have to show an obligation, which is a salary payable. And the same is true with accrued revenues. You have earned the revenue, but you have not collected it from your customer. And another thing with accrued revenues is if you have earned the money and you have not been paid for it, but you recorded it, you do not need to adjust. Let me give you an example of that. An example would be, I submit a bill to my client for $5,000. I date it in January. They're not January 1st. They're not expected to pay that bill until January the 31st. Do I need to adjust that at the end of my period when I'm preparing financial statements? The answer is no. The accruals hinge on a few factors. One, that you have earned the revenue, that the earnings process is complete, that you delivered to the client what they've asked for, that you have a value for that service. But it also says, did you record it? If you have earned it, and if you have recorded that transaction, meaning you've recorded a debit to accounts receivable and a credit to revenue, you do not require adjusting the account because the transaction has already been recorded. We're only talking about adjustments, meaning revenue that earned and not collected and not recorded. It's very important. You have not recorded the actual entry. It has not been recorded, meaning your AR has not been debited and your revenue has not been recorded. If it has not been recorded and you have earned it and you have not collected it, you need to adjust. Otherwise, that's just another entry that you'll have to monitor to make certain that you get your money from your client. And what you see here is just an example of how entries are recorded when it comes to commissions and, again, accrued revenues. It's important to notice that the revenue has to be earned. You have not received the payment from your client, and it has not been recorded already, previously recorded. Otherwise, you do not require an adjustment. Unearned services, that's just meaning you received money from your client but hadn't done the work yet. When you perform the work, you have to remove, in this case, the unearned revenue. So in this case, if you receive money from your client and they have not done any work, you're going to increase the cash, obviously, but you're going to also show a liability. You owe them service or the money back. Then, once the work has been done or partially completed, you need to remove the obligation and recognize the revenue. And here are just an overview of the type of transactions that you have to show when you are adjusting your entries. So the adjusting is going to be to make sure your revenue is measured and update your balance sheet, but also reflect any income that you've earned and have not recorded, and any obviously any expenses or obligations that you have not reflected on your balance sheet. And that's very important. So here we are. Here are the transactions that we talked about and their corresponding transactions, how it affects the balance sheet and income statement, expense and a credit, and then also depreciation expense and a contra account, etc. I think this particular exhibit is going to be very, very important, because when you record the entries, sometimes it gets a little confusing as to what you're debiting and what you're crediting. This really is a good cheat sheet for you. Now, again, the same thing is if you owe any kind of income tax expense, but you haven't paid it, you ask to show that there is an obligation to pay it at some point, and this is your entry to record it. And again, the whole point of all of this is just to know the general types of transactions that require adjustment. And so you can kind of look and see that all of these transactions have one thing in common, and that is none of them are affecting cash. That's important to note. So when you're creating adjusting entries and you see cash in one of your adjustments, you have to consider that possibility that it might be a mistake. Almost all adjusting entries will require a debit or a credit of some asset or some kind of expense or liability, but almost never will be seen cash in that transaction. And this is just another way for you to guide yourself and say, is this a transaction correct? Did I make a mistake? And if you see cash, chances are you need to go back and see and revisit that transaction, because cash is generally not going to be involved in any of these transactions for adjustments. And here is another presentation in T account format. Okay, finally, the adjusted trial balance. And remember, in the beginning of this presentation, I showed you the trial balance unadjusted. Now we're going to look at all of the transactions and the corresponding accounts that were adjusted. And if you can see here, not all the accounts were adjusted, just a few of them. And you can also note glaringly that cash was not touched at all. Of all the accounts that had been touched, cash was not touched. And that's important to note, because most adjusting entries, unless it's a mistake being made, unless you're correcting an error, cash will not be affected in your adjusting entries. And so generally, with regard to your project, that's kind of be what you're going to be doing. You're going to be recording months and months of worth of transactions. I would believe 6 months worth of transactions. But at the same time, once you create those transactions, you're going to transfer all that information to a T account, which will allow you to create this trial balance. Then you create all of your adjusting entries. Then you will then have sufficient information to create your financial statements. So what you'll be doing is creating financial statements based on F&G, which is called an F&G on your spreadsheet that you're looking at now, the debit and credits. You're going to be using those two columns to create your financial statements, corresponding to the balance sheet, statement of retained earnings, and income statement. So, constructing financial statements. Now, in the real world, financial statements are generally done via a computer using QuickBooks, Peachtree, or some other type of financial software program. In this class, however, it is important for you to understand how financial statements are prepared, and doing them manually is an essential part of that. So it's going to be kind of tedious, but I think it will be something worth learning how to do, which we will go through. But again, it's most important to note that you will be using your adjusted trial balance to create the financial statements in entirety. The income statement comes first, okay, which we see shows the revenue minus its expenses minus your taxes to get your net income. Then you will have sufficient information to create your statement of retained earnings. And again, if I go back to the previous slide, the $2,900 is going to be an increase in your net income. If it were a loss, it would be a decrease. And then you will have sufficient information, because now you take in consideration any dividends that you've declared. And you might see those type of transactions in your project, as also in some of your of your homework assignments. And then with that information, you've calculated the retained earnings. So then you'll need that to create your balance sheet. And if you can see, the balance sheet follows the assets equals liabilities plus stockholders' equity. So if you take the liabilities and equity and add them together and it does not equal total assets, you have a problem. Again, these are just little tips and tricks that you can use when you're preparing your statement so that you can identify a mistake. And you will make them. This is a learning process. And again, just little things that you can pick up from your reading to let you know that I'm off on this one. I think I need to go back and fix something. And that's one way to find out. If your assets are not the same or does not equal your liabilities and your stockholders' equity, you have an error somewhere. It is technically out of balance. And that's a good way to figure out what to do next. So, closing the books. Once you've completed your financial statements and they're clean and you've issued them, you need to close your books. Now remember, we're closing only temporary accounts. So let's talk about the temporary accounts. These are accounts that are only for 1 year or 1 calendar year or 1 fiscal year or 1 accounting cycle, however you want to term it. And they comprise of your revenues, your expenses, and your dividends. Permanent accounts like equity, liabilities, and assets do not close, and they have multiple periods in those accounts. And they roll over again and again and again. So we're going to close only the temporary. So if we have our revenue accounts and our revenue normally has a credit balance, guess what? We're going to have to debit that. And we're going to debit that to zero it out, and then the balance is going to go into our retained earnings. The same is true for expenses. Expenses are always debited. To close them or to zero them out, you have to do a credit. So you'll be crediting all of your expense accounts and debiting retained earnings. And the same is true for dividends. Dividends is a reduction in equity. So a reduction in equity is going to have a debit balance. So that means you're going to have to credit your equity by removing it or zeroing it out or offsetting it to net to zero. And then you're going to offset your retained earnings. And essentially, this is an example of how the entry should be recorded. And you should take note of that, because you're going to have to make certain when you create your journal entries, your closing entries for your project, this is what the format's going to look like. The accounts may very well be different. And the amounts most certainly will be different, but the end is the structure. You're zeroing out, or you're closing out your revenues to retained earnings. You're closing out your expenses to retained earnings, and you're closing your dividends to retained earnings. And you essentially now have closed the books. Now, what I had mentioned previously, I think early in the video, was assets and liabilities are based on a very specific format. They're based on, their presentation is going to be based on a certain category. Assets are going to be shown on the balance sheet in order of liquidity. That means long-lived assets are going to be shown last. Liabilities, on the other hand, are going to be shown in order of maturity. When does this liability become due to be paid? Accounts payable almost always going to be first. Sometimes salary and wages might be first, but in the end, the maturity is going to dictate when these items are going to be shown, how they're going to be shown on the balance sheet. So the most liquid cash comes first. And this just gives you some idea. Cash is most liquid, accounts receivable is relatively liquid, inventory less liquid, and obviously equipment and building are even less liquid. So liquid assets go first, and then we get our less liquid assets. And our long-lived assets like building, equipment, etc., furniture, plants and fixtures, those kind of things are going to be long-lived, and they're going to be shown last. Current liabilities paid within a year within the operating cycle. Obviously, accounts payable, notes payable due within a year. Salary and wages are just examples of that. Don't get too hung up on just all that detail. Just note that if it's going to be matured within a year, it's current. And then how close in that year that it's due is going to be whether it's going to be shown first, second, or third on the balance sheet. Long-term assets are 1 year or over 1 year. And they are not current, they are long-term. And obviously the examples would be a note payable, a bond payable. Obviously those type of examples are going to show you that they are to be paid in the long term. And here we have a consolidated balance sheet, and it does group the assets and liabilities in terms of short and long term, which makes it easy for you to be able to detect when you see an account whether or not it's long term or short term. So format, again, we want to show the format of the balance sheet and the income statement. And again, we're showing the assets are going to show, but first we're going to show the income statement. We show the revenues first, cost of services, cost of goods sold, etc. And then we're going to show our gross profit and other expenses, all other expenses that relate to that operating income, because what we're trying to calculate is income from operations. So any revenue or expenses that is not associated with operating the organization is not going to be shown in the operating section of the income statement. It's going to be shown below that. That includes income taxes and possibly extraordinary losses or gains, or gain or loss on the sale of an asset. Those kind of items are not going to be operational. They're going to be shown below, I would say, line 13. They're going to show in line 14, etc. Analyzing an organization liquidity. Again, how liquid is the current of the organization. The net capital is going to be something that needs to be shown. Also, you're going to be really try to calculate whether or not the organization has too much debt. Is it debts in light of, or in proportion, or comparable to the industry? So net working capital is going to be extremely important. Current ratio is another way to determine the organization's ability to pay its cash and its solvency. And the debt ratio is also important to note, that you have to just be certain that the organization's debt is really safe. It is a level that they can show that they can pay their debts when they're due. As I close, which is has been a long chapter, as I close, do not be overwhelmed by these types of transactions and these ratios. The most important thing to do is know what they mean and how they are interpreted and used within an organization. I want to say thank you very much for providing me your time for this particular very, very long lecture, but I think it will be very important for you to be able to go back and revisit some of the areas that we've talked about as you prepare to close the books for your project. Thank you very much for your time. And if any questions you have, please don't hesitate to ask them. Thank you.